But the S&P 500 off of its March lows, the question is, can we trust this rally? So today we're going to be looking at 5 reasons why we should not trust it and 5 reasons why we should. And at the end of the video, we're going to be looking at the number 1 chart to give us an idea if and when the market can get back to its uptrending ways. So let's start with the bad news first. Reason number 1 why we should not trust this rally is that the S&P still has not gotten above resistance. If we look at this chart, obviously there is a lot of overhead supply that we haven't even come close to testing yet. So before we can even get back to this area, say between 5,800 and 6,150, still have to negotiate this zone right around 5,650. Talked about this before. It's pretty obvious, right? It was number 1 downside target from a bearish pattern. It was the former breakout zone from the big bullish formation that was triggered in the middle of September. It was the July high. It was the August high. It was a pullback zone in October. It was a pullback zone in late October, early November as well. Very clear. And so far, even though Friday and Monday we had some good rally attempts, the S&P still hasn't gotten back above that zone comfortably just yet. And above that, as we know, the 200-day moving average is still right there, right around 5740-ish, and still moving higher. But the longer the S&P stays at these lower levels, the more lower prices get added in to the mix that will cause the moving average to flatten out and eventually roll over if things continue the way they are. So that will need to change. Number 2, the weekly moving averages continue to be resistance right now. And we've talked about those in the past, all on the way as we're testing these numerous months in a row and questioning if and when the S&P does undercut the 13-week, the 26-week, and the 40-week, all moving averages that we deem very important, what will happen next? Because since the beginning of 2023, when the S&P is undercut, those lines you've come close to, those ended up being extremely good buying opportunities. So right now, clearly the S&P is much more below those lines than we've seen in the past. So it makes us look at 2022 and wonder if the same type of thing is going to happen. Because as the market rolled over hard at the beginning of the year there and then failed to get back above that zone, failed at those same moving averages that were support, that just changed the market's complexion completely. Another factor that's similar to 2022 is that for a long time, we saw a negative divergence in the weekly RSI. And at the time, we had talked about that, and not that we should ignore it because it was still happening. At the same time, the S&P continued to rally, continued to take advantage of bullish patterns, and from this angle, continued to trade most of the time above each of the key weekly moving averages. So if and when this changed, this would then be a factor, which it has become right now. The same type of thing happened in 2021, right? It's not as apparent as right now, but the RSI did top in the summertime at 73, and then continued to make lower highs until the S&P 500 followed it down. Number 3, we just have a lot of 1% moves. And we saw this last week, and just looking at this table going back to basically the high point, just had a lot of dark red and some dark blue boxes, which just means we've had a very high frequency of 1% declines and a few gains as well. And this is how it looks in the chart here. Now, this chart we've shown before, and most recently in December and January, because we noted that, coming after a low volatility period, market paused, thinking that this would become then a bullish pattern that could be taken advantage of. And if that did happen, if we got that breakout through 6,100 or thereabouts, it would then lead to another low volatility environment, which helps breakouts work and then eventually have their upside targets hit. Remember, we had a 64.25 target for about 2 days before it got negated when this was happening. And, it looks similar to what we saw in May, coming back from the spring volatility, and in a much bigger way in September, coming back from the July, August volatility. But as we know, that didn't last long at all with the market falling apart. And now, over the last number of weeks, the volatility has been even more extreme. So this was a very short-lived breakout compared to what we saw in 2024. And now we have even more volatility to contend with. So it's going to take a long time for something like this to play out again and eventually get a large pattern to break out from a new all-time high. So we can't wait around for that to happen, right, before getting more bullish. But at the same time, there's something to recognize which has changed compared to 2023 and 2024. And we see it here again on the tables that we track. Now, last week we compared 2025 to 2024. This time we're looking at 2022, considering what's been going on over the last few weeks. So have a good amount more of 1% losses per month that we had last year, but compared to 2022, still not there just yet, getting closer. So when you look at these different months, these are all the months where the S&P had at least 10 1% moves up and down. And not surprisingly, they happen most of the time. 8 of the 10 months through October, and then still had relatively high amount of volatility into the first quarter of 2023. So if this is going to get worse, if we're going to have a major bear market, we're going to see a lot more of what transpired in terms of big moves on a more frequent basis, to the point where we'd have multiple months with at least 10 per month. Not there yet, but we still have a good amount of March left to contend with. Okay, number 4, short-term momentum. The 14-period RSI and the 2-hour chart. We've shown this chart numerous times as well. And the point being here is we finally got the bounce off of an oversold condition, but look how long the S&P held around this 30 level on a 2-hour chart. Talking about almost a full month worth based on where it started in late February, which is much different than what we've seen over the last year. The second part is that when you've seen the strongest rallies, one, sometimes two of the following happened. It was strong enough to produce an overbought reading on the very short-term basis. And as the market was coming back, that also led to new all-time highs each time. So we know we're not close to new all-time highs yet, but seeing this rally so far, not even 4% off of the lows, not be able to produce an overbought reading, that is concern as well. Because we need to see, of course, markets kickstart with those big 1% advances in response to those big 1% declines, but they just stop happening in the midst of what has been exceedingly negative momentum. Then even the short-term momentum can't turn higher. And when that can't happen, we can't expect too much more on a longer-term basis just yet. And lastly, we know that XLK Technology, large cap growth, has been lagging. And we know that because of the outside influence it has in the S&P 500, the broader market can only do so much without its support. And so one of the things that happened over the last 4 weeks was that the XLK was down over 10%. And these are the last few times that has happened going back to 2022. Not surprisingly, last happened in July and August. But again, that response was so quick that got wiped away almost immediately. And as we know, large cap growth snapped back, which then got the market moving. Now, different story in 2022. Even though we did see bear market rallies, as we know, based on what happened here, those did not lead to anything substantial until the low. So again, this is not surprising, but just understanding things that have been happening over the last number of weeks, we haven't seen in 2 years. Does it have to be completely alike 2022? No. But at the same time, we shouldn't ignore the fact that that has happened. And we have the luxury, at least, of going back not too far in time to understand how that played out. Okay, have we had enough of the bad news? Let's look at the good news, starting with long-term uptrend. Now, the S&P is testing the lower level of this upward sloping channel, as we talked about before. But so far, it's done a pretty good job holding steady, especially with last Friday's big 2% advance, which took it from noticeably below that lower line, just about back at it again. So still not out of the woods yet, of course, but we go back to the last few times that occurred, getting back to that lower line produced some of the biggest moves on the upside. And so we'll have to see. If this then becomes resistance, that's going to be a different story, but so far, hanging relatively close to that lower level and still maintaining higher lows and higher highs along the way. So number 2, most of us know by now there is a breadth surge on Friday and Monday, where the S&P had more than 90% of its holdings advanced. On Friday, March 14th, this was led by technology, big snapback. Then on Monday, March 17th, St. Patrick's Day, it was the field that led. That did well and actually pulled up the large cap growth areas that were lagging at the time. So we had two different flavors of 90% moves. Jason Gopfert of Sentiment Trader, of course, his outstanding work, looked at all the days where the S&P had 90% of its stocks at advance on consecutive days after hitting a 6-month low. As we can tell here, there's a pretty positive data, right? If you look in a little bit more closely here, we can see, especially between 2, 3, 6, and 12 months later, the S&P was up between 80% and 100% of the time after this occurred. Also, 9 of the 17 prior instances all happened after the great financial crisis. So we see what's been occurring most recently, and very positive win rate, very positive percent gains down the road. So again, we've seen breadth thrust similar to this. We've seen things get kickstarted after big moves to the downside. So this is obviously something positive. Let's recognize the fact that 1 week, 2 weeks, and 1 month later, the returns and win rates were not nearly as strong as down the road. Okay, we also are coming off of a 4-week losing streak. And according to marketcharts.com, since 2019, the S&P has done a very good job bouncing back from that. This is the chart. These are all the times that they occurred. Again, there are some in 2022 as well. And here is the data. As we can tell, up 10 days later, 7 out of the last 8 times with an average move of 3.25%. And again, I would point to 2022 here because as we can tell, it wasn't straight up like we saw 2019, 20, and even August, right? We had some jagged movement either in the first part of those 10 days or the second part, but the only time having a negative return after 10 days was from April to May 2022. So we could say that this is a very small sample size, but if you run it going back 20 years, right, to 2025, there were 17 non-overlapping instances, and the S&P was up 14 out of those 17 times, right? And over an 80% win rate with an average move actually better than what we saw over the last few years of 3.6%. Also, the market fell 10% in a very short amount of time, just over 3 weeks. So Ryan Dietrich of Carson Group, of course, ran these numbers. In all, it took 16 trading days for an all-time peak to go down 10%. And again, a lot of green numbers here between 1 month and 12 months later, especially 3 to 6 months later, up between 100% and 83% of the time. So again, down the road, coming back from a very quick correction like this leads to some good performance numbers. Now, one thing to recognize, of course, that one of these instances occurred in March 2000. Very interesting, of course, because that was the very beginning stages of the internet bubble bursting. And what has been happening over the last few weeks, a huge technology unwind. Yes, the mega cap growth names are getting a lot of the focus, but there's been some other small cap and mid cap growth names that have gotten hit even harder, like the holdings within ARK, for instance. So 12 months later, we're down 12%, but in between that time frame, still positive. And of course, the biggest decline within a month came during the COVID crash. Okay, and the fifth reason to be positive and be supportive of this rally attempt is because of seasonality. Jeff Hirsch of Almanac Trader, again, does fantastic work. And I've shown this chart before, but he shows us that in post-election years, right, between 1949 and 2024, this is what seasonality looked like, right? Looking at just all post-election years in black here, it's tended to find a bottom between late February and early April. So yes, this pullback has been severe, which we just talked about, down 10% in less than 3 weeks. But in terms of when it is happening, not surprising. So what would surprise us going forward? Well, if this type of rollover continues at this pace and it continues through April, that would make this look a lot different. But up to this point, if we were to ask bulls and bears coming out of 2024, the S&P was up 2 straight years, 20% each, right, with a new president taking hold, but of course, a lot of the policies now unfolding that we had heard about. I don't think it's too much of a surprise to see what has happened, but now to see it on this chart, understanding the fact that it is fitting into this seasonality pattern of post-election years, then we should understand that this maybe wasn't too much of a surprise. Now, we have to see what it does after this point, but combining it with the four other factors we just reviewed makes sense, and is obviously constructive as well. So, reviewed 5 reasons to not trust this rally attempt, and now 5 reasons to trust it. So, what do we do with that? Well, we go back to our 5 traits that make up an uptrend, right? And we won't talk about all of these, of course. Number 1, which we look at first and last, are successful bullish patterns. And now it's very hard to talk about that, of course, when the market is moving down an accelerated clip like we just saw. In fact, I get asked a lot of times, where's support, where are the patterns? My response is there is no support, there are no patterns. You have to be patient for all of them. So number 1, to form a bullish pattern is the market has to stop going down, right? Number 2, you have to see some sort of upside follow through, and from there see a higher low. And then that could possibly be the beginning stages of a bullish pattern. And that can be taking place sometimes, again, in a market like this on a short-term basis. So this is the first symbolism of anything happening from a pattern standpoint, again, through March 17th, where the market stopped coming down, higher low potential, now potential breakout through this area, right? So we're recording this in the middle of Tuesday. This looks like it already is negated. That's beside the point, because we want to see something like this occur. Now, we could rip apart this pattern, say it doesn't look like anything, this isn't an inverse head and shoulders pattern, so forth and so on. I think everyone knows how I feel about this. If you can identify the structure, you can identify where the key levels are to keep that structure alive and where a potential target price would be, that's what we care about. And from a very short-term basis, these get negated all the time. But we can't ignore the fact, because at some point, one of these formations is going to work, and we want to make sure we're there for it. The reason why we look for patterns, even on a 2-hour chart, is because we can get an indication of a market really turning higher if they start to work out. Here is a perfect example in 2020 of why we started to get bullish on the market really in early April. Now, all along the way, we know these moves were explosive on both sides, but never did we see any sort of pattern breakout occur until after the market low, after the comeback, finally got a breakout through this, say, 2450 area. Had the initial breakout zone, then that got tested, held, boom, hit the target by the middle of April. That was the first upside target, the first pattern being hit, and other bullish patterns started to fire from that point, and we know the rest. And eventually, that led to the formation of one of the biggest patterns that we've seen over the last decade, which was this one. We talked about this in the past when we compared it to our last bullish pattern from 2024. And so the bottom line is we're in the middle of a highly volatile trading environment. There's going to be potential reasons for this to continue and potential reasons for this to end. We have to weigh the negatives and positives along the way. Continue to look for bullish patterns. Whether they play out or not is going to tell us a lot about the environment that we're in. So if you like this video and you want to learn more about if we are in fact in a bear market, check out this video, which we recorded last week. Thanks, and I'll talk to you again soon.